bigger problem we see is the economy having been floated in 23 and 24 by illegal immigration. A large part of our growth came from that whole movement into basically an organized illegal operation that, we think a large majority of the deficit spending we saw funded that through NGOs and other agencies, and then direct payments to illegals. So that really floated the economy, and that's all coming away. So we see a housing crisis coming next. And when we say crisis, I don't want people to freak out. I mean, it's needed. I mean, home prices need to come down. People can't afford homes, and new home supplies, at all-time record or near all-time record levels. There's no transaction activity, and the housing market was really buoyed by the marginal renter, which was the illegal alien. That momentum's all going the wrong way, and PMI, has been a problem for 2 years. It's been showing recessionary signals globally, and the only economy that was really outstanding was the U.S. economy, and that's all going the wrong way. The second derivative, government spending, even though the Trump administration is really not cutting spending, the second derivative is changing. The growth is flattening, and that's all you need to cause a softening in the economy. And that's what we put out a report that we're selling on January 9th, detailing what we were seeing. And you can buy it if you want at our website, financetechnologies.com with a PH. So that's kind of the broad swath. We're already starting to see indications that the economy is slowly starting to roll over. And we'll see if our call's right. We think we're going to be right in a very big way.
Well, thanks for setting the stage on that. Let's dig into a couple things on that. You said, I think what you said is after you talked about the Fed bailing out the banks in 2023 through the BTFP, that the Fed is not going to give money to bad businesses or bad investments anymore. I think that's what you said.
They're not going to loan money to. It was easy to provide liquidity versus treasury assets that were underwater. They're not going to provide liquidity to bad loan decisions, bad credit decisions. And what's going on with the commercial real estate problem? And by the way, this all eventually affects lending. A bank's main function is to juice the economy by lending. When you start to accumulate bad debts on your books, you stop lending as much. And what's going on with the commercial real estate is they've been extending and pretending. And the Fed put out a report in November of 2024 detailing that. And I think they're going to start cracking down on banks. Coincidentally, during the Trump administration, that may be a political move, who knows? But I mean, this has been a problem for well over a year and a half. There's also starting to be indications of problems in auto loans, and there's delinquencies in homes are rising. So we have a classic credit cycle coming, and it's just inevitable, and it'll cause the word deflation to be mentioned temporarily, because we know that deflation is not allowed under the rules of the bankers. So we're predicting inflation CPI headline to sometime in the next 6 to 12 months print a sub 2% number. The biggest component of inflation is shelter. It's about 45% of the CPI number. That's sticky. It takes time to adjust. And so we're expecting a recession. We're expecting the Fed to do what it does, lower interest rates, and then maybe if the crisis is, if it looks like it's going to go systemic, they're going to print a ton of money, and the government will have to do deficit spending, and then we're back in the reinflation of the bubble if they can do it again.
So you said deflation is not allowed in bankers' terms. It's really not allowed in a debt-based monetary system, just overall.
Correct. It's not. If allowed to go unchecked, the daisy chain effects or collapse.
Would you say, you mentioned, how this actually started in 2019 and then the COVID sort of excuse came along. Would you say that it actually started back in 2008 when we really sort of had the first QE, Maybe the Fed tried to allow the bubble to deflate like they had done in previous cycles, 2000, et cetera. But then it became too systemic, right? They had to bail out the banks. They had to do the quantitative easing. It levered up the system to a point now, and 2019, 2020 showed that and even 2023 showed there's zero appetite to allow it to sort of deflate on its own, and they have to keep reinflating.
Yeah, it's interesting you talked about the great financial crisis. That's when a lot of things changed. That's when we saw unprecedented monetary policy, which now everybody expects, and it's not as unprecedented. It's a tool in the toolbox. And what that did is the real economy, if you go back, really kind of died globally. And what floated the economy for the next 14 years was unprecedented monetary policy coupled with government spending. And the government, as a percent of GDP, not only in the U.S., but in Europe, China, you name it, grew its share of the pie in GDP. And that's changed a lot of, what's been going on economically. So the closer you are to government and government favors and the printing press, the better off you've done. So the economy showed growth, but the problem was over time, there was a wealth disparity effect. And that's why, if you want to ask yourself why populism is on the rise, it's basically because the rich got richer and everybody else got poorer. And it's been an economy of the rich, not of the middle class. And Trump was elected primarily because there was minus 2% real wage growth going into the election. The last time that happened in 1980, Ronald Reagan swept in, and it's Bill Clinton in 92. So, Trump was going to win no matter what because of the economy. It didn't matter.
Got it. So if the system structurally, fundamentally changed in 2008, got so levered up, you could see 2019, 2020, the response was way faster, right? 2008, they allowed Bear Stearns to go down. It took 7 months to get a bailout. In 2023, it took 6 days to bail out the banks. But you think that now maybe the Fed would sort of change their tune and say, well, let's just let these bad loans go bad and let's see what happens with the deflation?
Well, it depends. They can't be seen as bailing out. Politically, it's going to be a lot harder to try to bail out the banks. During 2020,
sort of like take the loans on their books like they did with the MBS in 2008. Like, you don't think that's politically sustainable?
Well, they could do it, but they will only do it if there's enough pain. So that's why they'll do it, but they'll do it after a big correction and people are freaking out and beg them to do it. They don't want to do it ahead of time. 2020 gave them great cover. I mean, they bailed out Citadel Capital. They gave them emergency repos during 2020, and there was also, and they also basically privatized the corporate credit market. They started buying. I don't know if people remember this, but they started buying onto their balance sheet Apple bonds. So they basically privatized the corporate credit market. The problem with that is it's kept corporate credit spreads tight, and that's driven a massive amount of misallocation of capital, as you would imagine. So, right. And the other problem is this. In the dot-com boom, we had a corporate fraud cycle, and then we had the Fed do their easy money after that bust. That led to a banking fraud cycle. And now we have 14 years later, I would say a central bank government fraud cycle. And we're discovering all sorts of fraud, through what Doge is exposed and whatnot. And it's not so much that the Fed will become trapped when another central bank has a problem, and the Bank of Japan is kind of in a problem right now. They can either, continue to print money to float the yen carry trade, or their people will continue to get poor, and there's a currency crisis. So the release valve on the sovereign debt crisis was always going to be the currency markets, because eventually the currency markets will revolt if one country. If the markets determine no mas, then it's over. And then the whole thing has a problem. So the Fed, is the Fed going to bail out Japan? I mean, right? So this is where we are. It's very precarious. We don't have a crystal ball, but what we do know is there's an economic slowdown coming. There's going to be, a problem in the stock markets, and we're expecting yields to go much lower. And obviously, if you believe our call, you want to be up to your eyeballs in risk-free assets like the U.S. T-bills, notes, and bonds, and not have anything with any risk assets.